Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, November 22nd, and then we'll see how things look for Friday, November 24th. For those of you outside of the U.S., please be reminded that on Thursday, the markets will be closed in observance of Thanksgiving. And before I get going on the video, I want to wish all of you that are watching this video, and even those that aren't watching the video, a very happy Thanksgiving. I'm very thankful that I'm able to do these videos. I'm thankful for the comments that I hear from you, and I'm thankful that people find value in what I'm trying to do. So I hope you have a really good Thanksgiving. Let's go back and talk about what happened. Right at the open, we had a higher open and prices climbed up to R3. That's because in Tuesday's session, the pivot levels were not very far apart from each other. So it didn't take us very much to get up to R3 at 45.68. We fell back down below R2 at 45.52. We came down to R1 at 45.45. Then as the day went on, we bounced back above R2. Then we came back down and retested R1 again. So that was a successful test. And we closed higher above R2. But we did see a nice little advance. We were up 0.41% on below average volume because we are in holiday mode. We are positive with our technicals, but if you saw the thumbnail that I used for this video, there are some signs of weakness that are starting to come into the market. Now, this could get overcome. We could come back next week. There could be some high volume, and we could actually go up from here because we do have positive seasonality. But right now, a number of our different charts are suggesting that maybe there's some weakness. Now, some of this also can be the way these indicators are calculated. They can only go straight up for so long before they start to get a little bit tired. But nonetheless, I'll point those things out to you. It's pretty market friendly right now as far as interest rates and inflation and growth concerns. For right now, the market seems to like where things are at. We also have some geopolitical events. Apparently, there's going to be some kind of a temporary hold in the fighting between Israel and Hamas, as there's some kind of an exchange that takes place there. We'll have to see how all of that plays out. And then any other things that can happen over a holiday weekend, either intentional or unintentional, that the markets may try to fixate on and think, uh-oh, things are going wrong here. Some comments that we can make. Israel and Hamas have agreed to a 4-day pause in fighting as part of a hostage release deal. The part that I heard is that, okay, if there's more hostages to be released, maybe it'll go to 5 days. And we'll have to see if the current agreement even works out the way they are saying that it should right now. The broad market in Wednesday's session did perform well. We are seeing some improvements across the board. It's not just the mega caps that are leading things higher. There was also an explosion right at the U.S.-Canadian border. At first, that kind of freaked out the market, thinking, uh-oh, here's some terrorism going on. But the last report that I saw said that they're not ruling this as an act of terrorism. I'm not sure what it was, but it's probably not a good place to have an explosion happen. Oil ended up closing down a little bit at $77.05. So there's a little bit of a decrease there. On a short-term basis, we still have a pretty long list. A new addition is the VIX based on 9 periods. That means the VIX is moving pretty fast and it's going to the downside because the VIX has been going down as stocks have been going up. We still have our 20-period exponential moving average, the Stochc RSI, Williams percent R, the CCI 14 and 20, the stochastics, the RSI based on 9 periods, the boom indicator with the 20-period moving average study, and then the slope oscillator. We're watching all of these. They're getting pretty extreme. We also have kind of a long list here with the intermediate term, with the CMB composite, the PMO studies. A new one that's back on the list after it had dropped off is the rate of change going back 20 periods. The RSI 14 also was on, dropped off. Now it's back on. The Sean trend meter, the TTM squeeze, the McClellan oscillator. It was on, dropped off. Now it's back on. When we look at it just for the S&P, that's looking extreme. The NASDAQ 100 bullish percent index and the S&P 500 new highs, new lows study that we do based on 10 periods, that is also looking extreme as well. The current scenario has not changed. That right now, the market's okay with where things are at. You might be having some personal frustrations, but the stock market tends to like where things are at. And yes, that the Fed will be keeping rates higher for longer. Perhaps they are done raising rates, and the market is trying to build up the scenario that at some point in the future, the Fed may actually start to entertain cutting rates. But we're not hearing any of that. At least I'm not hearing any of that coming out of the Fed. That's pure speculation on the market, and that's what the market does. They develop these scenarios, and then everybody starts to do it, and then we see, okay, is that going to be confirmed by what the Fed says or what the Fed does? We will be keeping an eye on the situation in Israel. We're also watching oil prices and then earnings as they are released. The dollar was down and interest rates were also down, which did give some support to stocks. We still have the 10 to the 5-year, the 10 to the 2-year, and the 10 to the 3-month. Those yield curves remain inverted. Sentiment still ticked up a little bit more. We're not extreme yet, so we can still go with this for right now when we're talking about how's the market feeling. And they're pretty positive at 66, where it had ticked up from 64. Our trend is still positive. The ADX is above its moving average. That suggests the trend is strengthening, and the green line is on top. So that is positive. Our bias is positive, and that's more or less just the one day. If we have an up day or a down day, where the momentum is the last 2, 3, 4, 5 days kind of taken together, and I've kept that at positive as well. This tends to be the most subjective part of the video. This is where I actually reach a conclusion, where I let the charts throughout the rest of the video kind of tell us actually what's happening, so we don't have to really come to a conclusion ourselves. We can just see what's happening graphically, and then it's kind of the conclusion kind of comes to itself. That's the approach that I take. All right, so let's go back and look at the economic reports. In Wednesday's session, that's when we had the most number of reports for the week. We had some that are on Thursday that are now on Wednesday. One of those being weekly jobless claims. They came in a little bit weaker than expected. We've been seeing this tick up. It actually ticked down to 209,000. They had expected 227,000. The continuing claims came in at 1.840 million, and I have charts of both of these to show you. Durable goods were down minus 5.4% on a month-over-month basis. That's more than the minus 3.1% they had expected. Last time they were up 4%. When you take out transportation, durable goods were unchanged month-over-month. They had expected it to be up 0.2% as it was last time we had the report. Consumer sentiment, a little bit stronger than expected at 61.3. They had expected 60.9. Last time we had this, it was at 60.4. When you look back a year ago, it's at 56.7. And I have a chart. The weekly mortgage applications index was up 3% week over week. When you look at refinance applications, they were up 2%, and purchase applications were up 3%. Here are some charts where we've been going up slightly with the weekly jobless claims. Well, when this really started to come down in the latest reading, that's starting to turn the moving average over. And this is what the Fed is using to justify rates going higher, is that the employment situation is pretty strong. Well, as this has been going back up, maybe the employment situation isn't as strong, but now we see this really falling off. So that kind of throws that scenario at least into question for right now. The continuing claims also turned down, but they're still going up overall. Now, I don't want anybody to be unemployed, but the stock market likes if this is showing some weakness, as is the previous chart. That's what they want to see to justify either rates not being raised anymore, and in fact, at some point, possibly lowering rates. So we just go with what the market likes for this one. Here are all three, including the unemployment rate together. The red line is the initial jobless claims where they did come down. The blue line is continuing claims, or are continuing claims, where it's rolling over, but a little harder to see. And then in the last employment report, we had the unemployment rate coming in at 3.9%. Here are the weekly mortgage applications where we were up 3% from the previous week. Here are durable goods orders where they did decline, but they're still just barely above zero on a year-over-year basis. When you take out aircraft orders, we actually saw a bit of an increase above zero. When we look at month over month, we did see a decline in this reading for durable goods. Here's consumer sentiment, where people are feeling a little less optimistic. The blue line is the total reading, and that's declining. The gold line are the expectations looking out into the future, and they're not feeling really good about that. And the purple line is how do you feel right now, and that's also declining. You've got a lot of folks that are pretty apprehensive about things. Here's our chart. When we also plot a 2-year yield on this chart, the blue line is consumer sentiment, where it had been showing some improvement. Now it's starting to fall back. And we're seeing that there's a really wide spread between how people are feeling and the 2-year yield, where typically they will go in the same general direction, and typically they don't get too far apart from each other, even though they're on different scales. We've been seeing a pretty wide separation between the two now going back a couple of years. We did close at 4.42%. We were down slightly with the 10% yield, but that's still above the 4.02% that can bite into corporate earnings. Here's our intraday chart, where we set the high pretty much right at the open. We immediately shot up to R3, which I had to calculate, and that's just because the pivot levels for Tuesday were so narrow. It didn't take us much to get up here, but it's kind of interesting that that's where we stopped. And the cool thing about this is these pivot levels are on the chart before the market even opens. So we can watch this and know and see these things ahead of time. Well, then we fell back down below R2, R1. We came down to R1, which is acted as support. Then we tried to bounce back up, chopped around a little bit, came down to R1 again, tested that, and then saw a little bit of strength going into the close and ended up having an up day. So when we look at the intraday chart, we were more positive before the market opened. That's the blue area. And then we shot up, chopped around quite a bit, and then saw some strength later in the day. And now we're trailing off. Now the futures are still trading, even though the market's closed for Thanksgiving. If you watch the futures during the off hours like I do, you can still follow those. They're not going to move all that much, but if something big happens, you can kind of keep an eye on that. Here's the growth of value intraday chart, where we did see value outperforming growth. The red line is above the blue line. We did see a little bit of a tick up here right at the end of the day, but growth did underperform value when we look at the S&P 500 growth to value ratio. The end of day charts, where growth and value were up for the large caps, but growth underperformed. They were about even for the mid caps, and actually for the small caps, growth did outperform value. So when we look at small cap growth to value, even though we've been chopping sideways, we did see a bit of an improvement here with the ratio. And this is what I compare it to. I look at the index that's really been under a lot of pressure, but the growth to value ratio has been pretty much chopping sideways. You can take that. I take that more as positive because this is holding up for right now. We look at the mid caps, turning down just a little bit since they were about even with value. But again, as we were going sideways with the ratio, we were coming down with the mid-cap index. That, to me, just suggests that the market has been holding up. Then we look at the S&P 500 growth to value ratio. This is the one that I pay attention to the most. It actually ticked down just a little bit, even though it's in a longer-term uptrend, and we have been pretty much chopping sideways. This ratio is still holding up, though. When we have another way of looking at growth to value, it's breaking out above these previous highs, and so far that's been holding. We look at the condition of our trend, and this is kind of weakness sign number one to be aware of. The trend is fine. The ADX is above its moving average and going higher. But look at the green line. We're getting really close to that 40 level. That could suggest that the positive trend may be getting a little too high for right now. And we're seeing that more pronounced on the short-term chart, where it's actually starting to cross above 40. Now, that's not necessarily a weakness sign. That's just something to be aware of. There are some other charts that I'll show you where we're actually starting to see things turn down a little bit. We are seeing volume dropping to below average. And when we look at this oscillator, it's been that way now for a number of days. Here is sentiment, where we continue to go up, at least with a closing basis with stocks and on our indexes. So this continues to fall when we look at the average of the VIX from 1990 to 2022. But it doesn't mean that it's always going to do this. As we get into the end of November and the beginning of December, we start to see some gyrations going on. Is that going to play out in a similar fashion this time based on other things that we're seeing? However, this sentiment gauge, which is called the Ulcer Index, the higher this gets, the more freaked out the market is. It's still very low, suggesting there's not a lot of fear. Here is the VIX, where it continues to fall, and we're coming back to previous lows on a closing basis. That's the line chart. And then on the bar chart, we're also coming down to lows. We're also below the moving averages, and the moving averages are actually crossing over as well, suggesting there's not a lot of fear. We look at the VIX of the VIX, which typically goes down when we have an up day. Well, it ticked up just a little bit. We might have seen a little bit of an increase in hedging ahead of the 4-day weekend, but still, this is giving us a very low reading, suggesting that there's not much volatility in the market. Here is the RSI based on 9 periods where we're starting to get extreme. We've dropped down below this 30 level, suggesting that maybe we've dropped a little too far too fast. That means that stocks have been going up a little too far too fast. Here's the VIX to VVIX ratio, which continues to decline. That is longer term positive. We're also turning down when we look at the VIX to 3-month average of the VIX. That's declining. That's longer term positive. The VIX to move ratio is still very low, showing there's not a lot of volatility in stocks when compared to bonds. And this is interesting too. We really spiked up after Tuesday's session that folks were maybe starting to hedge, and maybe they're getting a day early on their Thanksgiving vacation. Well, with the update, we did see the equity put call ratio start to come back down. It's still kind of high, but we didn't see as much hedging, or some of those hedges actually ended up coming off. But when we look at the 5-period simple moving average, it continues to go back up after we spiked up and started to come down. That's positive. The fact that it's starting to go back up, now, some of this can be explained through logic. We're dealing with a holiday weekend. But if we come back and this continues to go back up next week, then this is going to cause a little bit more of a concern. And then here's just a longer term look at that same chart, how we spiked up and are coming down. And when you see other times when we spiked up, that will typically mark some kind of a bottom in the market. This is also, it's kind of hard to see, but we're starting to roll over with a little more pronounced look with our 253-period moving average of the equity put call ratio. So this is turning more longer term positive. The other fear gauge that we look at is continuing to drop, and that suggests there's not a lot of fear. And the other fear gauge is pretty much chopping sideways right now, but it's not really increasing or decreasing at this point. When we look at the risk on to risk off ratio, it was down slightly in Wednesday's session. It has been bouncing back up, but we're still seeing some more weakness longer term with this ratio. We want to see some improvement with this if we're going to turn more positive. The advanced decline line, we're looking more healthy when we look at the average okay, let me try that again. If we look at the advanced decline line based on price as well as volume, and we're above the moving averages. And we're coming back up and showing a real nice little breakout in the new highs. So that's turning our 5-period up, and our 10-period is continuing to go up with a little bit of a breakout above resistance that we saw in Wednesday's session. That really helped create some new highs. And we're not really seeing an expansion of new lows right now. On a volume basis, we are still looking more positive with the advanced decline ratio, with both the blue line and the red line above zero and advancing. Accumulation distribution starting to flatten out, not really a warning sign now. We're above an advancing moving average. The chicken money flow also still shows strength for the smart money. That's not really a warning sign. And when we look at the NYSE cumulative advanced decline line, we did see some improvement, but we have not been able to get back up to this trend line. We are starting to break out a little bit with our regular advanced decline line. So this is breaking out above a downward sloping trend line. Our NYSE advanced decline line, it's kind of in between both of the moving averages and showing some improvement. And we're still noticing the divergence here where we didn't break higher based on price with our NYSE common stock advanced decline line, but we have been able to break higher based on volume. For right now, I would take that more as positive because that just shows that volume is leading price. When we look at our advanced decline line studies, we're seeing an improvement with the NYSE common stock advanced decline line. We were up with the S&P, the mid caps, and we're still showing some improvement here with the small caps, but we have not been able to break above the moving average. Our short-term chart, where we are still above this pivot point, and that took us a few days to be able to get above that, and we're still hanging on to that for right now. We have this previous high. If we start to go back up, this red area that I have marked here may end up acting as overhead resistance. And on the bottom, we just see where each day now volume has been getting lower and lower below average. The 20-period exponential moving average is still extreme positive. We're turning back up with the 50, and we're pretty much flat with the 200. And then our other short-term indicators, the Stochk RSI is extreme positive, as is the Williams percent R, the CCI 14, even though it's ticking down, it's still below, or it's still above 100. We're ticking down here with the 20 period, and it's still also above 100. The force index did just tick up a little bit, but it's above 0, it's green, and that's positive, and it's also above the midpoint. We are still extreme positive with our stochastics. Now, this is short term in the top, intermediate short term in the middle, long short term on the bottom. This is a further subdivision of the short term time frame. And we're still up here at the +3 standard deviations. So we're exceeding the envelopes here, or envelopes, depending on how you want to say that. And this is still suggesting that we've gone up pretty far, pretty fast. The boom indicator is still above this 100 level based on 20 periods. That means we're getting kind of far away from the 20 period moving average. We are showing some improvement with the 50 and have not gotten too far away from it. And we're also showing some improvement with the 200-day moving average. Some intermediate term charts. We're no longer extreme positive with the balance of power. It's still positive, but it has been coming down. This could be potential weakness sign number 2. All right. The CMB composite is still extreme positive and not really showing any weakness here. The go, no-go system, which is a trend-based system, it continues to be positive with dark blue bars. We're not really seeing anything here with the highest high value. We're continuing to go up. The midpoint is also continuing to go up. We're even seeing the red line starting to go up. So this chart's looking pretty positive. The TTM squeeze looking kind of extreme positive. That's, again, not really showing any signs of weakness. But when we look at the longer term chart, there were other times when we had this high of a reading, and that ended up marking a top in the market. Not saying that's what's going to happen this time. We can only compare it to what has happened in the past. Looking at the rate of change going back 20 periods, we did drop off of the list. Now we're back on it, showing that as we calculate this move up that we've seen, it's gone up pretty far, pretty fast. Here's one of the other warning signs just to be aware of, the ease of movement. This suggests what's the path of least resistance. If this is going up, that means the path of least resistance is to the upside. Well, this is starting to roll over. Yeah, deal with that voice change. This is starting to roll over just a little bit here. Now, some of this could be the way the indicator is actually calculated. Some of these lower values are starting to fall off the calculations because we've been going up for a while now, and that could also be giving us some lower readings. But remember, people look at this and they make decisions based on this, and so sometimes it may end up being a self-fulfilling prophecy. The Erin indicator is still looking positive, where we have the green line on top. That means buyers are in control, and the red line are sellers, and they continue to decrease. So we are above 0 with the oscillator and advancing. The S&P McClellan oscillator is above this extreme positive reading. It could still go higher. So that's just suggesting either good momentum or that we're getting overextended to the upside. And when we look at the summation index based on price, we're advancing. And we're also advancing based on volume. That's still positive. And we're also going up with the summation index for the NYSE based on price and volume. That's positive. We're flattening out a little bit with the Swenlin trading oscillator based on price, but we're starting to see a bit of a decline here based on volume. That potentially could be another warning sign. But when we look at our momentum, we're still going up with the PMO. We're also going up when we just measure it based on price as well as volume. We are extreme positive with the PMOs that are rising. We're also extreme with the buy signals, and we're coming up and still doing okay with the PMOs that are above 0. But we continue to be neutral here with the Elder's Impulse system. We had a couple of up days and it hasn't switched to green. Not a real big deal, just something to be aware of. The parabolic SAR is still positive. And then the slope oscillator. This is just barely starting to roll over a little bit after giving us a pretty extreme reading. Now, some of this could be the way it's calculated. It doesn't go back for as many periods. And so earlier periods that were making this go up are now dropping off the calculation, and we're getting higher periods. And so this can't help but start to roll over. The MACD still looking good on an intermediate term basis and continuing to be positive. This is longer term. This is a weekly chart of the MACD. We continue to be crossing above the moving average. If we can close Friday's session without being down too much or actually being positive, that's going to change this over to a weekly positive signal. So looking at our oscillators, Still looking pretty extreme with the slope oscillator. We're getting up to this blue line with the TSI. Those are our short-term oscillators. Where the MACD, the PMO, and the PPO, those are intermediate-term oscillators, and they're still hanging in there. And our longer-term oscillators, the TRIX and KST, continue to be positive. The Sean trend meters starting to camp up here for a couple of days now in extreme positive territory. And we're above all of the plotted moving averages. The longer we stay above this, the more these lines below it will continue to go up. The bullish percent index is still chugging along and looking positive there too. It had an advance in Wednesday's session. And we're showing some improvement here with the NYSE bullish percent index. We haven't crossed above 50 yet. That would be more positive if we could get above that, but we haven't done that quite yet. This is another warning sign. We have the NASDAQ 100. These are the mega caps. These are the stocks that have really been driving the market higher. After getting an extreme positive reading, we are now starting to come down, even though we had an up day. Another thing to be aware of. Now, it could recover from this, but we just have to go with what we're seeing right now. The chicken oscillator also ticked down just a little bit on an up day, but we're still positive with this indicator. The money flow, after giving us an extreme positive reading, is now generated an overbought signal. That's when it drops down below this level. And the ultimate oscillator is also just getting ready to drop below this extreme positive reading. That is now an overbought signal. The vortex, even though we've had an update, we're continuing to drop off with the green line. This could be another potential sign of weakness. Now, some of this could be the way it's calculated, but we've been starting to come down as we've still been going up with price. Even though this is rather extreme, the fact that it's coming down and the red line starting to go back up is a little bit of a concern. The RSI based on 14 periods is now extreme positive, and we're also extreme positive with the RSI 9. On balance volume continues to be above an advancing moving average. That's positive. We showed some improvement with our 200 period moving average study for the S&P, as well as an improvement with the 50 period moving average study. And the copy curve starting to roll over just a little bit. Again, not turning negative, nothing to freak out about. I know the people that are more bearish on the market, they're like, give it to me, give it to me. I want this market to tank. We're just seeing some signs right now that may turn out to be nothing. But right now we have to pay attention to them. But this continues to be positive. Again, this could be part of the way it's calculated. Longer term with the Copic curve, when we had a high reading like this, sometimes that will end up marking some kind of a top in the market. We want to be aware of that. The Pring bottom fisher, which ended up generating a good solid signal, even though it didn't really fulfill what we consider a signal to be for this indicator, it's starting to flatten out just a bit. And then I don't have any Fibonacci studies to show you, but the fact that we broke out above this previous high, that's always a positive thing. So when you just look at price on the chart, that is showing things improving on a closing basis. But you notice where we opened and where we closed, they were kind of near each other. That's sometimes can be a bit of a warning sign. That's kind of a doji look if you're into candlesticks. Our different charts, though, when we look at the trend, we are still positive with the Heiken Ashi, we're positive with the Kegi, we're positive with the Renko, and we're positive with the three-line break. So it's not picking up necessarily any weakness. We're not seeing any weakness here. We're still above this long-term trend line going back to 2009 when we look at the S&P 500 weekly chart. But here is another long-term signal that we need to pay attention to. And there's a day lag on this. So this is based on Tuesday's results. It takes a day for this to be updated. This is the Zohorchak method, which generated a buy signal that we've seen for most of 2023. When we started to run into some weakness during the fall, it ticked down to this 4 level. Now it's actually ticking down. Now it hasn't gone to a full-blown sell signal yet, but it has dropped below 0. And this could be longer term negative, a warning sign that we need to be aware of. Looking at our other indexes, we did see an improvement with the equal weight index, even though it's underperforming the S&P. The ratio between the S&P and the equal weight index is still hanging in there fairly good for right now. We were up with the Dow. We were up a little bit less with the transports. We ticked up just a little bit with the utilities. The transports continue to underperform the Dow. That's also another warning sign. So when we look at the ratio between the Dow and the transports, we were up just a little bit here, meaning that the Dow was outperforming the transports. We want to see this ratio going down for it to be more positive. When we look at the ratio between the transports and the S&P, we're just kind of chopping along sideways. We're not really seeing anything necessarily positive or negative at this point. We are above the R2 level with the Dow. We had a death cross here for a day or two, and now it's crossing back over and giving us a golden cross. So that's positive. The diamonds, though, still remain neutral even with the up day. The NASDAQ is still above the R2 level, so support has been holding at least to this point. That's positive. We're above the 61.8% retracement level for the NASDAQ. That's positive. And we're above this R2 level for the NASDAQ 100, and we're back to testing this previous all-time high here. That's usually a good thing. But when you look at the Elder's Impulse system for the Qs, we still remain neutral, and we have that open and close bar really close to each other. But on a momentum basis, the NASDAQ 100 is still doing okay, but is it starting to roll over just a little bit? Now, if you try to front run this and go negative before our charts really confirm this, you could just get decimated. I'm just trying to point out some potential things that could be developing, but we're not really seeing any confirmation of that yet. The small caps have not been able to get back above their 200-day moving average. Even though they were up over 0.5%, they're right in between their 50 and 200-day moving averages. And the Russell 2000 small caps, we ticked up a little bit with the RSI, but we're still working off of a death cross. Shorter-term momentum continues to be positive. And we remain neutral for the small caps for the Elder's Impulse system. The mid caps are still hanging out above their 200-day moving average. That's positive. But we remain neutral for the Elder's Impulse system on the mid caps. The financial sector showing some improvement. It was up 0.4%, starting to generate a golden cross here. That's positive. The micro caps are slightly above 100 now. That's also positive. Here's another kind of warning sign with the FANG index. Could be nothing, could be something. We've seen a really healthy chart pattern as we've been going up. But you see this kind of doji look again, where we opened and closed and not too far from each other. It could turn out to be not that big of a deal, but we see it right here, so we want to make a note of that. And we're coming right back up to this resistance where we did break above it intraday, but then we closed right down a little bit below it. The dollar was down just a little bit, but still is in a longer-term uptrend. Keeping an eye on bonds, not a real big change. We were down just a little bit with interest rates, so we were up just a little bit based on price. Our possible positive scenarios, seeing a little bit of weakness here with the Qs to S&P, but still above the moving average. Discretionary, this has been kind of a disappointment. We're coming down to the moving average now and not really breaking out. We rolled over just a little bit, but large cap growth is still outperforming large cap value. So the large caps are hanging in there, the mid caps, and we're seeing some improvement with the small caps according to this ratio analysis. And we're getting extreme now with our 10-day average of the S&P 500 highs minus the lows. You can take this two ways, that this is extreme and we're due for a pullback, or this is suggesting good momentum. We don't really know at this point. And we're still looking a little more positive in the broad market. We continue to be above zero with the 5-period moving average of the highs minus the lows when we look at the Amex, NASDAQ, and NYSE. So that's suggesting broader participation of buying. This is also turning longer-term positive. We're crossing more convincingly above zero with our 50-period moving average study of the new highs minus the new lows. Because the black line is above zero and it continues to be positive, so that's bringing the red line back up. We're wondering, have we started to drop here with the 2-year yield? Okay, if this continues to drop, sometimes that gives short to intermediate term support to the S&P. The S&P to utilities ratio has been chopping around a lot lately, but overall it has been declining, which could be positive for the S&P. And even though it ticked up a little bit, the staples, the S&P 500 ratio has been declining, which again, often gives support to the S&P. Then looking at the 19-day exponential moving average of the advanced decline ratio, we're positive based on price as well as volume. Tom Bowley's research, wondering, are we in the negative part here, or are we coming more into the positive part of November, where based on his research, there is positive seasonality. At least for Friday's session, there is positive seasonality. So what's our outlook? We're still dealing with earnings season as they are released. Please be aware that the stock market will close at 1 p.m. Eastern time on Friday, which I always love when I lived on the West Coast, because that means I'm done working that day at 10 o'clock in the morning. How cool is that? We're watching the whole situation between Israel and Hamas, wondering if it's going to escalate, wondering if this hostage exchange thing is going to actually happen. The technicals are positive, but we are overbought. Is there some signs, or are there some signs of weakness starting to develop? There are a couple of reports coming out on Friday, but they're not really big market movers. They're the import and exports for the S&P global thing, and they're not that big of a deal. And then we will be watching the geopolitical events, and of course that can change at any time. We will be closed on Thursday for Thanksgiving, and there's really no reports of note coming out on Friday. Looking at the Stock Traders Almanac statistics, we are positive across the board with the Dow, S&P, and NASDAQ. We'll also be in the last trading day after options expiration week, and we're up almost 62% of the time, where we're down about 39% of the time. I know that adds up to more than 100%. We will be on the 17th trading day of the month, where during a pre-election year, we don't necessarily see some strength during this time. We actually might see some weakness, where historically we tend to see some strength here. So we're kind of getting some mixed signals there. We are in a positive seasonal time when we're during a pre-election year where the current president is running for re-election. We're also in a positive seasonal time when looking at 1990 to 2022, also positive seasonality when we go back to 1950. And then when we compare pre-election years with non-pre-election years, they're both positive in the longer term. And we might be coming down here a little bit, according to Carson, where they see some weakness in the latter part of November into early December before we tend to see some strength going into the end of the year. Looking at the NASDAQ, where this is the time right now for the NASDAQ, where we might be seeing some strength, at least according to the Stock Traders Almanac. We also see a bounce up historically with the Stock Traders Almanac. So our scenarios, we cannot justify the down one. The weaknesses that we're seeing, they're just warning signs for right now. They may get dealt with. They may develop into something. That's why I do these videos every day. I know it seems like I repeat a lot of the same things, and sometimes I do, but this is how you really get insight to what's happening in the market. You look for these incremental little changes that most everybody else misses, and then you're aware of it, and so then you can then develop a plan based on that. So we are still leaning more towards the upside. That's what the evidence is suggesting, and we're not going with a sideways trend because there's really no evidence to suggest that right now. The warning signs, where's the risk on posture? We're still a little bit concerned with that. It's showing a little bit of improvement on some days, but it's going down in the longer term. The Russell, the small caps, and the mid caps are working off of a longer term downtrend. And now we have a new one here. The 253 period equity put call ratio is looking more convincing to be turning down. And our daily special K chart is positive, where the weekly chart is still negative. On a momentum basis, the S&P and NASDAQ are still positive. The equity put call ratio in 5 period, it's continuing to go down, even though it's been chopping back up a little bit. I'm not quite sure what to do with that at this point. The parabolic SAR and the vortex indicator are positive, but we could be seeing some warning signs from the vortex. The bullish percent index, though, it's still above 50 and going up and not extreme. That's still positive. Small and mid cap growth, I showed both of the charts. They are still longer term positive. And the financial sector has now generated a golden cross. Where the 50 period exponential moving average study of the new highs, new lows, it's now positive and going more above zero. That's longer term positive. So our conclusion, we are positive, but we could suggest that we're overbought right now. We want to keep an eye on these areas of weakness to see if they continue to be more pronounced. We can say that in the short and intermediate term, but we're still positive in the long term. You could put a warning sign on the long term because of the Zohorchak. That's a long-term buy or sell signal. So you could theoretically add that to the list. So thank you. Again, I want to wish all of you a very happy Thanksgiving. Whether you're watching this during Thanksgiving or before Thanksgiving, even if you were watching it after Thanksgiving, I hope you had a great Thanksgiving. Enjoy watching lots of football, and I will talk to you in the next video.